And we are live on Odds Property Investor. We bring the big names, and we're gonna have the big capital growth fun here this week. How you going, Jeremy?
Yeah, good. How are you guys?
I'm
Welcome.
fantastic.
Great to have you.
Yeah, come
Thanks
great.
for having me.
Yeah. So how's your day been anyway, Jeremy? What's been happening today?
Well, I've spent most of the day just stressing about this in the evening. No, I've been busy working on a new website, looking at data, handling customer support inquiries, meetings. Yeah, loads of meetings.
The fun stuff. Down and dirty with data. That's what we should have called this session, actually. Down and dirty with data. Yeah, missed opportunity there. Mate, we wanted to have you on for we wanted to have you on for years now. We've been running this for about 3 years now, and we've always said, Jeremy Sheppard is the man to get on alive, because you're one of the OGs of property data. You run, as you can see here on the screen, dsrdata.com.au, and you've got some cool new things in the works as well. And you've really, revolutionized the supply and demand and understanding what actually matters in property. And we've got a number of myths that we're going to go through today. Where is buying in a capital city the absolute best thing you can be doing for capital growth? Maybe not. But anyway, I'm jumping into it. How are you, Jeff? How have you been, mate?
I'm fantastic, man. Just kind of kicking into, like, it feels like there is a bit of rush pre-Christmas. Like things are sort of ramping up, but it's creeping up on us. So no, going really well. But it's just super excited for this session, because I think data, there's not many people out there that I would be. There's many great data sort of analysts and all that sort of thing. But I think, Jeremy, you are one of the original sort of people who've done it, and just to sort of understand and unpack some of that stuff and give people the knowledge, so that if they decide and want to, they can go and check it out themselves. So there's going to be a cracking session. So we're going to be making capital growth great again. And you're not, full disclaimer, you're not a Trump fan, you said, or maybe you are, I don't know, but I'll let you spill the beans on that.
Not really, no.
No. I mean, not many people are. But no, so going to be a great session. And drop your questions, people. We're going to be talking, I'll give a summary of what we're talking about, but going to be awesome. So actually, before we do content of the week, should we talk to what we're going to... Yeah, let's do it. So tonight, we're going to be talking about the core metrics that people should be considering when they're looking at capital growth. And these aren't necessarily... Actually, maybe it will be the Holy Grail. Is that too much to say, Jeremy?
Oh, it is. I do get asked this question a lot. Just give us half a dozen metrics, or 2 or 3, Jeremy, that you should be looking at. And there is sort of a problem with it. I mean, I will rattle some off. You ready for some of the best?
Yeah, ready for it. Let's say we'll get the audience salivating, but drop us a comment, drop us a like, all that sort of stuff. And we're going to be diving deep into some myth busting capital growth things, and finally we're going to unpack some sort of examples and what we can learn from those examples. Because I think it's important it's all good and well to say, yes, this is a theory and here's what sort of has happened, but let's actually look at how it's played out in a suburb or two, and then we can sort of then say, well, does that give us some indication as to where the next kind of spots where capital growth there's great capital growth potential. So say that 10 times fast, maybe 20. But no, so I'm excited. It's going to be a huge session, and the crowd is rolling in. They're going wild. It's like that stadium, the cricket stadium where we won when the Indians were going crazy, not when we were, because we were silent. I love my cricket, and Jeremy does too. So let's roll into content of the week. Want to go first, Jeremy?
Oh, okay. So my content of the week is I'm reading a book on Russian puzzles. I like puzzle books because they exercise my brain. I try and do one every couple of days. And I just saw on Amazon just this book on Russian puzzles. And I thought, different culture, different way of thinking. So that's my content of the week.
And what is a puzzle? What's a Russian puzzle opposed to a English puzzle?
Well, they're all
Aussie
in
puzzle.
English, I should say, because I can't read any Russian, but they're just some odd concepts. Some of them are as simple as like just arranging matchsticks, which there's nothing Russian about that. But things might be ordering some coins to make a symbol in less than 3 moves, that sort of thing. Yeah, that's just exercises for my brain.
I like it. Keeping sharp.
Yeah, trying to stave off the Alzheimer's. Yeah.
What about you, Jeff? What is your content of the week, mate?
So mine is actually not property related, but I think it's something that's a bit of a passion of mine, and this is maybe a little bit controversial. So bear with me. It's not about Donald Trump. It's not the art of the deal, but no, there's a book called The Carbon Almanac, which was forwarded by Seth Godin, and it's something that it lays out a lot of the sort of key and critical issues of climate change and all that sort of stuff in an easy to digest sort of thing, and I think that's something that I like to think of myself as a longer term thinker, hopefully, not too short term thinking. So to me, that's something I am sort of reading along with, and it's just unpacking some of the science and laying it out in simple terms to understand what's actually happening, and is it all bad or is it good? Like, just kind of similar to what Jeremy's going to be doing here with capital growth. He's going to be busting some expert sort of capital growth myths and all that sort of stuff. So yeah, that's my content of the week.
I like it. Yeah, I mean, climate change is changing. If you have a look at the Logan flood zone maps now, they've recently updated it. So if anyone's using any old mapping platform that is using the old map, don't use it anymore. You have to go to the Logan hub. But there is a lot of properties that are underwater now that weren't that previously weren't. So make sure you check that out. Currently underwater. It doesn't look like any flood has hit those areas, but it just now needs to reshuffle the deck a little bit. My content of the week is a book and an audio book. I've read it several times. They even have a podcast. It's called The One Thing.
Gary Keller.
Gary Keller. Fantastic book. Really simple premise. What is the one thing we can do such that by doing it, everything else becomes easier or unnecessary? And I love that, actually. That's kind of like property data. What are the few that I actually need to worry about and think about, so that I don't have to think about all these other ones? I know that's a terrible example, but it makes you think.
Wasn't the worst,
what are the things that wasn't the worst, wasn't the best? You can't win them all. Anyway, that's my content of the week. Let's dive in. I'm excited to introduce this man, but I'm not doing it. Jeff is. But before we do that, we got to jump into something else. Hang on. Where's this? There it is there. Boom. Ladies and gentlemen, we have a special announcement from the master of commercial property investing, Steve Polisi.
I love commercial property.
Get ready to have your minds blown as Steve is back, and he's got some pretty exciting news for us. Steve is unleashing his second sensational book upon the world, and get this, for the Oz Property Investors members out there, he's giving it away absolutely free. Yep, 100% free. Yep, 100% free for all property enthusiasts who want to learn and grow on their commercial property investing journey. But he's also added a little extra chili to make this deal even spicier. With this free book, you'll also receive a complimentary 1-hour strategy session with the man himself. Imagine a full 60 minutes with Steve's commercial and property genius dedicated to helping you master the intricate dance of commercial property investing. And who better to dance with the man who looked better than Patrick Swayze in Dirty Dancing? I don't know about that. Want to grab this offer? It's super easy. If you're live right now, click the link in the comments and secure it today. If not, grab your device, open up the browser, head over to polisiproperty.com, look for the book page and grab your free copy of Steve's latest masterpiece. And when you're checking out, make sure to use the exclusive code OZPROP to secure the free book and also your free 1-hour strategy session. My only concern with this offer is that Steve's going to have to turn it off soon, as he can only do so many sessions. So if you want to secure your spot, do so today. Oh, nearly passed out there.
That's a fun one. But so, who is the man of the hour, or man of the hour and a half? How long we go for? How long it will stay? We might just. So, Jeremy, you have been investing in property for over, well in excess of two decades. It's just 2 years there, but it's much longer than that. You created DSR over 10 years ago in 2010, and what that is predictor of capital growth for every suburb in Australia. Actually, now that I'm asking, is it every like all the 15,000 suburbs in Australia? Like even the ones that is that
Where data is sufficient.
okay?
Most of we score each market with its statistical reliability as well. So 2/3 of the property markets around the country really, there's so little real estate transactions going on that you just, you'd have to say that's a high risk.
Yeah. I'm sure we could probably ask you about 10 questions about that. But you've helped thousands of people, sort of thousands of investors, answer the question: where should you buy based on the budget? And that's probably the big question that a lot of people ask in the group: where do I buy it? I've got 400K. Where do I buy? So people have those kind of questions. Maybe, I don't know. We might not answer them, but drop them in, and we'll see how we go. Probably won't. But you've been published in over 50 public articles published, been on Sunrise, heaps of property podcasts. I think I've heard you on heaps of them. So it's an absolute pleasure to have you on. So thanks for joining us tonight. And actually, I want to ask you, what's one thing that people should know about you that they don't?
Oh, wow. They should know.
Yeah.
I'm not a data scientist.
Oh.
So I get mistaken for a data scientist. I know enough about artificial intelligence. I can code in Python to get myself into some pretty bad trouble. So I outsource that to the professionals. But I'm not a data scientist. I call myself a property data analyst.
There you go.
Oh, there you go.
Boring.
What's the difference?
Lack of skill, lack of
Right.
maths. At the data science sort of level. My accountant, he calls me a data anal cyst. Deliberately gets it mixed up. Yeah.
Jeez, that's
Jesus.
that's a fun one. Maybe not fun actually.
Yeah. Classic accountant.
On that note, so the question we love asking people usually at the start of our shows: tell us about what was your first property you purchased and the story behind it.
Yeah, well, I've got a great disaster story for my first property. Property investing for me has been a long learning experience. So I bought my first property in Western Sydney. It was in Penrith. It cost me $206,000, which seems amazing now, but this is back in 2002. And my plan was to renovate the property. I wanted a property that had a granny flat in it so that I could have two tenants and increase the yield. And the vendor that was selling the property, he said, "Look, I've got a tenant that's in another one of my investment properties. Would you like to hit the ground running?" And I ummed and ahed about it.
He's trying to offload him.
That's right. That is exactly it. Very intuitive there, Jeff. He had a dodgy tenant. He was self-managing, so he didn't have access to that sort of blacklisted database. So he's got himself a dodgy tenant. How do you get rid of them? Well, you give it to a novice investor. And this tenant moved in. They moved into the granny flat. So I was having the property, the house renovated. They moved into the granny flat. They didn't pay any rent at all. Like as soon as they moved in, that's it. Just not a single cent. And the tradies that were renovating the house, they noticed a lot of gear go missing. Some tiles have gone missing. Jeremy, you're gonna have to buy some more. And eventually they just shut up shop. They said, "That's it. Tools down. We're out. You get rid of that tenant. We're not coming back."
Wow.
Until you do. So I was getting no rent. I've got a unrentable house as well because everything's been stripped bare. And this tenant has obviously been to Tenancy Tribunal before. They were up on all the tricks. It took about 6 months, maybe a little less than 6 months to get rid of them. The night before the sheriff was there to forcibly evict them, they blocked up all the drains, left the taps running overnight to flood the property. And that's the last I saw of them. Anyway, cleaned up the mess. The insurer didn't really want to pay. They said, "This is your problem. We'll give you a few $1,000. You should be grateful." So it was an absolute nightmare. But I remember a year later getting a market appraisal from local real estate agents, and the property had grown significantly. And I thought it was because of my fantastic renovation. But really, I was in the middle of a national property boom. It's early 2000s. So everywhere around the country was growing fantastically. And the suburb that I had just happened upon had done very well. So, but I didn't know that. And it took probably a decade for me to figure that out. I had a couple of other good fortuitous moments as well. I mean, I had disasters as well as lucky spells, but it took a while before I realized I could have been just sitting on my hands collecting equity via capital growth. It's a lot easier than renovating. So I don't do renovations anymore. Anyway, that was my first foray into property investing. A disaster.
That's a hard start. It's a very hard start.
And I kept going with it, which was the surprising thing.
Yeah. I mean, this is what stops a lot of people, right? 70% of property investors have only one property. It's generally because of poor experiences. I saw some of the comments. People were like, I asked the question, what stops people? And the first one was, oh, you're terrible tenants. And I attracted my first tenant in by saying, hey, what was it? 2 weeks free rent if you 2 weeks free rent if you join at $350 a week or whatever it was, to try and get someone in at the rate that I wanted. I wanted it to be $350 instead of dropping it and getting a good tenant. I incentivized thinking people couldn't do basic math, and got a terrible tenants, trashed the place, and it was a horrible experience. But it's because I didn't listen to my expert team. I didn't surround myself by smart people, and I just thought I could do it all myself. Terrible idea.
Yeah. So when you think of that expert team, are you talking about like a property manager?
Property manager. Yeah.
Yeah. And you think about the cost that comes with a property manager. It's worth every cent, isn't it?
Like 100%.
Yeah. I can't understand.
It sucks. I even right now, I have had this property. I had a property for a year, nothing. I've heard nothing. The tenant has no problems, and I'm still paying. It kind of sucks to pay it out, and then it's only in the back of my mind, like, oh yeah, but something's going to happen, and then I'm gonna. If you're doing it by yourself, you don't stand a chance. And then you don't know all the tribunal rules, and then you'll
as well.
Yeah, you can break the rule,
especially this year. Yeah.
Yeah. So
anyway,
let's
keep going.
Oh, actually, before we get into that, sorry, go.
Oh, no. Before we get into it? What are we doing?
Oh, I just wanted to ask because I put a bit of a particularly provocative post up because I do follow some people on Twitter, and I probably shouldn't because it's probably not good for my mental health doing this. But the property pessimists out there, they seem to get very excited at the slight little turning of the Sydney or Melbourne property market. They sort of think that everything's about to capitulate and drop 30-40% imminently. What are your thoughts what do you think the data sort of says about where the property market will likely head? I just wanted to ask that up front.
This is a frequent question I get asked too, and my answer is that I don't really look at the broad property market almost at all, because I really am just interested in suburbs. And historical data has shown there's never been a time in the last 30 years where you can't buy somewhere and get double-digit growth over the next few years. So it's more a case of as soon as you got the equity, go for it. And whatever the media is saying, it really just doesn't matter. But I can't see anything in the data at the moment that's suggesting that we're headed for bad times. It's pretty much business as usual.
The mortgage cliff is coming.
Someone's popped in the comment. The mortgage cliff is coming.
That's somebody obviously. That's so. You know Jimmy?
Sell to me. No. Well, what's actually? I wanted to ask you something about Victoria, Jeremy. What's the go with Victoria? How are the yields so low? How are the prices not really moving too much? Like, what's the go with that market when everything else is booming? Victoria's like, hey, I'm here. I'm doing my thing.
Yeah. Melbourne has historically had lower yields than say Sydney, for example, and it's bothered me too. And I haven't found anything in the data to try and explain that. I'm still asking the same question. So, sorry, I don't have all the answers. Right now, I guess there have been some changes to Victoria's rental laws, which could affect things. But I think that those are relatively minor sort of changes. They're just annoying. So yeah, upshot, I don't know.
Yeah,
I like that. I like the candid. It's not like you're trying to put together a thesis or something. But yeah, but you're just kind of. But
Yeah,
yeah,
I'll ask my data scientist. Let's look into this. Let's try and answer this. What is it that's unique about Victoria that might? I mean, we'll only be speculating anyway. What we do know is, like you said, yields are lower. Why is that? Yeah, we
it's
can
because they're
come up with some
Victorian.
theories.
That's why. There's no absolutely
is it
no.
the
Yeah, I can
two-
say that because my dad's Victorian, so I can get away with that somewhat, maybe.
The other question I had, Jeremy, you talk a lot about the supply and demand ratio. Yeah, I mean that's what DSR stands for. How long do these? So we're going to go through some data in this slideshow, I'm sure, but maybe I'm jumping the gun a little bit. But how long do these things last for? So when the supply is tight, the demand is intense, supply is tight. Like how long of a time period have we got before it's like, okay, see ya?
Yeah, good question. The typical answer I give is 3 years, but it varies dramatically from suburb to suburb. It could all be over in like 18 months, or it could drag on for half a dozen years. But generally, supply and demand balance relatively quickly when you think about how slow property is. You think of a long term, you've got to hold property for at least 10 years, that sort of thing. But I think that buyers are pretty clued up and things are getting faster now. There's a lot more data that's available online. Your eyes and fingers can do the walking online. So we are finding that things are getting quicker. But yeah, to answer that question with a precise figure when there isn't really one, I would just say roughly 3 years. And then prices will sort of peak, maybe even retract, and then you'll have a long period of pretty ordinary growth before the market cycle repeats.
Is it? And
Okay.
where's Victoria in this cycle? Like, are we at the bottom of this? I mean, again, I'm throwing Victoria.
I think Jeremy's going to say he doesn't look at a state level. You look at suburb level, don't you? So
not even the city, not even Melbourne or Geelong, or it'd be at the suburb level. Yeah, because you got to buy a property that sits in a street that's in a block that's in a suburb that's in an LGA that's in a city. So yeah, by the time you're looking at that macro geography level, it's sort of lost a lot of context.
Is Hobart too big of a suburb to ask you about what your thoughts on Hobart are?
Yeah. And you know what people will say? What do you think about Batman? There is a suburb in Victoria called Batman.
Oh yeah, Tassie. Yeah. I'm sorry.
Yeah, and I would have to look it up. So yeah, a lot of the time I just have to look it up unless it's a journalist and they've primed me beforehand. Hey, we're going to ask you about Sydney and affordable or unaffordable markets. Then I do look it up. But it's really hard to have your finger on the pulse of thousands of suburbs around the country, and especially when I don't really look at cities. I'm gonna have to say I don't know.
No, that's all right. It's all good. We do have some examples that you probably do have sort of do all across. So we'll save it for that. But I was just curious because like Hobart had that, or a lot of suburbs around Tasmania had that big sort of growth, and I sort of said, well, how long? I can't see it continuing because it was going on and on and on. And I thought eventually it will sort of just level out and plateau, and it sort of has done that. But I just sort of would be interested. But anyway, that's fine. Let's kick on to our first big sort of area or subject, which is what data points, if people had to sort of look at 4 or 6, or you pick however many you want to. I won't sort of hold you to a number, but what are those key data points that people should look at?
These ones?
Yeah, so that's the 5. I've picked out 5 that I believe are pretty good. The thing is, it's not really going to help people much. I'll explain why in a minute, but let me just define some of these terms. So market cycle timing is a score for the probability that a particular market is about to enter its next growth cycle. So historically, we've seen a pattern in the way values change over time, and we're trying to match that pattern match this suburb's historical growth to that pattern. So the market cycle timing formula looks at growth over the last 6 months, year, 2 years, 3, 4, 5, all the way back to 10 years. And it just examines that growth profile to see how closely it resembles the stereotypical growth profile before a boom. And it's a score out of 100. 100 means yippee, this one's booming about right now. 0 is probably reflecting the peak, and 50 is sort of in the middle. It's a bit of a meh sort of score. Don't do anything here. Anyway, market cycle timing highly correlated to capital growth. A very good metric. Long-term growth. Go on.
What's that made up of? Like, how do you? What's inside market cycle timing to work those numbers out?
An examination of the historical growth pattern. It's like you're looking at a chart, and but it's the algorithm that's looking at a chart, and it tries to pattern match to the stereotype of growth prior to a boom, and then
do you see like matches between, like, talk about Geelong, right? Do you see a Geelong match a Geelong cycle? So let's say Geelong's last cycle was 18 months from boom to like peak to trough, and then do you see like that keep repeating itself for that particular market? And then in WA, it's this, or is it just completely reshuffled?
Yeah, it's the same sort of formula for every suburb. So you could have a real estate culture in Geelong that results in different sort of cycles, different timing.
Right.
But because it's such a small market, you wouldn't be confident of whatever you find. And so we really do need to spread the data out across thousands of suburbs to have a sufficient sample size to be confident of what we're saying. So there's this concept in artificial intelligence that the data scientists talk about, is cross-validation, and it's taking continual subsets of the full data set and seeing if the theory holds true for each of the subsets. And if it does, well, for most of them, then you've got more confidence. If you get a different story for every different market, then you can't really use that sort of metric. It's inconsistent. But yeah, that explains the. Anyway, long-term growth is number 2. Yeah, so that's just the compound annual growth rate over the last 10 years. A very easy one, this one. And what I've seen in the past, looking at historical data, there is an inverse relationship between past growth and future growth. So if the last 10 years growth has been excellent in a particular suburb, then you can almost bet your bottom dollar that it's going to be poor in the next 10 years, and vice versa. So what you're actually looking for with long-term growth is low long-term growth over the last 10 years. It's remarkable just how consistently suburbs tend to balance out. And I'll talk more about that later on. There's a term used, mean reversion. So mean is just another word for average. And when data scientists talk about reversion to the mean, it's really just a case of, well, this period of time, the market had above average growth, but now it's reverting back to the mean, the normal sort of growth. Or this market had below average growth, and now it's catching up to others. And you see a lot of that. So this reversion to the mean is a very strong predictor of capital growth. And days on market is one a lot of people are familiar with. It's just how long properties spend advertised for sale. So they'll be listed for sale on Domain or realestate.com.au. Eventually there'll be a buyer, and they shift from the for sale page to the sold page, and that period of time is days on market. So in hot markets where demand exceeds supply, you find the days on market is quite tight. Like Jeff, were you saying that you found a suburb where days on market was like 8?
WA.
Safety Bay, 8, which is extraordinarily low. That's really fast.
What's
so
happening is agents are selling them off market and then listing it and then putting it as, I think over there that's based 8 days to unconditional contract. Probably that's not
right.
settled.
Yeah,
but yeah.
Right.
Yeah, so you picture yourself as a buyer and you've missed out a few times. You don't hesitate. You jump on them, and that's what days on market is trying to measure. That sort of reflection of demand relative to supply. And auction clearance rates, of course, everyone knows about. This one's a bit of a nuisance in that you don't have auctions all around the country. And even if you do have an auction clearance rate for a particular suburb, it might be based on only 2 sales or 2 auctions. So you could have had one property passed in, the other one sold, and you've got a 50% auction clearance rate. So it's not reliable at a micro level, but it is a good indicator of capital growth. And the last one that I've got on the list there, online search interest. Whenever you go on domain or realestate.com.au and you're searching for property, that search is recorded, and it gives you an idea of how many people are performing searches versus how many properties are available for them. And so that data formulates the online search interest. It doesn't really have a unit like, kilometers per hour or something like that. It's just a number, just a score. But it's a good reflection of demand relative to supply based purely on searches online. So those are the 5 metrics that I've picked out. Sorry, go on.
Yeah, is there a way to find online search interest, like a free way on real estate or domain? Do they list that and advertise it for the suburb?
They used to. I'm a bit out of touch now with what's
They do,
available
Joe.
freely.
I'll show you exactly where to find it. It's
Oh,
they
then, mate,
haven't
share.
called it on. Well, I think it's. Let me just show you.
Yeah,
I'll
online
bring it up.
search interest is my term for it, but I think they call it demand.
Interested.
They call it supply and demand, and I just thought, that's a little bit too broad for one metric.
Let me show you. Give me a tick. So
Okay.
I believe this is what it is in buyers interested. It might be a bit small.
Right.
Yeah.
Yeah. That
Zoom
looks
in.
familiar. Yeah.
And it used to be
Okay, so
called number of people who seriously interested. I mean, seriously interested, that's a bit of an interesting term. What does seriously interested mean? But yeah,
So I think
that is
they've
a lot.
applied
That is
a
a lot
bit
of interested buyers.
Yeah, what's that for? That can't be for a single suburb, is it?
That's
Oh, it
Kerwin.
is. Kerwin, yeah.
But Kerwin's a huge suburb, so
Right.
I would say let's have a look at Geelong, because I'm just curious now. I reckon it'll be
Geelong's massive
significantly.
now, isn't it? Significantly more, surely. Geelong is massive.
But it's only
31
got
houses.
18,
Oh, okay. 18.
1895.
No, it's the suburb. It's the suburb of Geelong, not the.
Okay, let's look at Corio. Oh no, it's a suburb. Yeah, let's look at Corio then. I'd be interested with Corio. But Jeremy, while I'm doing this, I wanted to know with your sort of, let's see, there's still a lot of people interested in Corio, isn't it? Corio. Look at that, 14,
Right.
14.
Yeah.
So it's
I
half of Kerwin.
remember recommending Corio years ago to some buyers agents, and one of them said, Jeremy, I wouldn't drive through Corio without bulletproof glass. And
Pretty dramatic, isn't it?
I think my reply was, well, murderers have got to live somewhere too. I didn't know the suburb.
Why would they murder where they live though? That doesn't make any sense.
Yeah, that's right. They go elsewhere.
You want to stay alive, right? You go somewhere else. I mean, not encouraging or downplaying murder. That's a bit of an issue. But no. So
back then, the demand to supply ratio was very high for Corio, so I'd recommended it without knowing the suburb and its reputation. And over the next few years, it had fantastic growth, but they didn't buy that.
Can we go back to that slide, Joe? Because I wanted to ask about this, about the long-term growth in particular. And you can ask because let's just say, how does, and I'm going to sort of, because I like to sort of understand where things sort of, and if things are all things being equal. But let's just say Bondi, for example, like a blue chip. I know you sort of talk about blue chip, but I'm just picked one of the most expensive suburbs in my head. But if that has experienced poor long-term growth, as in over the last 10 years, but it's still unaffordable, would that then still hold out for that type of suburb?
Well, it's that affordability or unaffordability that is the reason behind this mean reversion. So the best way to explain this, I use the apples and oranges analogy. So picture yourself 100 years ago, walk into a fruit shop, apples cost 1 cent, oranges cost 2 cents. Now, if apples grew in value at 4% per annum, whilst oranges grew at 8% per annum, then 100 years later, you'd walk into a fruit shop and an apple would cost 50 cents and an orange would cost $44. In other words, you could buy 88 apples for the price of a single orange. Now, you walk in and you think, well, there's no way I'm buying an orange. So that reduces the demand for oranges, decelerating their growth rate. And you look for an alternative, apples. That increased demand accelerates the growth for apples. So over time, there's this tremendous balancing act between property markets. If one continues to outperform, eventually it becomes considered way too unaffordable. It's overpriced, and buyers evaporate, and they look for the opposite end of the spectrum, where property markets just haven't moved and they seem incredibly cheap, good value for money by comparison. And so there's this tendency for all property markets over the long term to grow at the same rate.
Yeah. Okay. So what about like there was a comparison of like Kalgoorlie. Was it Kalgoorlie? Like some big mining town. How does that factor in into those situations?
There are exceptions to just about every rule. So I used the word tendency because it's a general rule, general pattern. So what I've done in the past is I've had a look at over 1 year, any 1 year growth period in the last 30 years, and there's like hundreds of thousands of property markets in this circumstance. How broad a variety of capital growth can you get in a single year? There could be 50% capital growth and then minus 40% and anywhere in between. Then I doubled the growth period and saw pretty similar sort of things. And I doubled it again. So I'm looking at 4 years now. And I noticed there's a trend. That bell curve has started to narrow. And then I looked at 8 years and it's narrowed even further. And then I looked at 16 years and it's really obvious the trend that's happening. And I've got this bell curve at 32 years that is just, it's like a single point. There are exceptions. It's like playing the lottery. The general rule is you lose, but there are exceptions.
Sometimes you might be.
Yeah. So you will have
$30.
ghost towns around Australia that have been that way for decades and they're not about to change soon. But as a general rule, if you're in one of the major significant urban areas with population more than, say, 10,000, if you've seen poor growth over the last 10 years, you should not sell up. You should probably hold. But having said that, there could be another 10 years. So there's nothing. All of these things are just increasing your chances. Using these general rules to increase your chances.
Yeah,
that was crazy.
Oh,
I
and
just looked up Broken Hill, and it's going on an absolute tear. I mean, it's from a low base, but in the last 2-3 years, Broken Hill's gone from 120 to 190,000. So it's almost doubled, but low base though. So I mean, yeah. I don't know if I'd get all that excited about that though.
Yeah, just before we get off these metrics onto the next topic, I just want to point out that I'm picturing a bunch of investors looking up these statistics and thinking, oh, I'm going to find these sort of suburbs. You will never find a suburb that has the best market cycle timing and the best long-term growth and the best days on market. So at some point, you've got to merge them together. So let's say you only had two metrics. Let's say it's market cycle timing, first one on the list there, and online search interest, the last one. If you are to pick the best suburb in Australia based on those two metrics alone, bearing in mind that you will never find a suburb that has the best MCT and the best OSI, you need to know the correlation coefficient, which is a term data scientists use. It's a number that reflects the predictive capability of a metric in picking the target variable, which in our case is capital growth. So unless you know that correlation coefficient, how can you decide between two suburbs that have different market cycle timing scores and different online search interest scores? So even though you've got all these suburbs, there's no way any human being, all of these metrics, there's no way a human being can figure out how to merge them together to beat an algorithm. So there's simply not enough data we've got in those five. I mean, the algorithms that we've been working on this year, I asked the data scientist, which is Luke Metcalf of microburbs.com.au. I asked him, how many metrics are we talking about here? And he said, oh, I don't know, thousands. So we're in a different world now than when I kicked off the DSR 10 years ago. First of all, there's an enormous amount more data, and secondly, there's much better technology to assess that data. Now, we may not have literally 1,000 different base metrics, but what the machine does is it comes up with different combinations of them. It might be a combination of auction clearance rate and online search interest, and it doesn't have any human understandable concept, so you wouldn't give it a name, but it's something that the machine has found is a good predictor of capital growth. And there can be thousands of those, what they call synthetic variables. So we're at a point now where we just can't do things ourselves. We really do have to rely on the machines.
Yeah, well, because that was one of the things I wanted to talk to is property data has evolved over the years, and it's gone from very basic to, looking at the back of the magazines to figure out yield and stuff like that. What are some of the common data misconceptions that you're seeing out there in the marketplace at the moment that you can kind of dispel? Are you seeing any major flaws or thinking that people have that there shouldn't be?
Yeah, all the time. And I mean, the expert busting series that I wrote, series of 37 blogs, was just full of these sort of topics of stuff I've heard people bang on about, and it's really I blame content marketing. So it's a lot easier to just make something up and post a blog or a podcast or whatever, rather than spend the weeks acquiring the data, cleaning it, pumping it into a database, performing all the rigorous analysis that you have to do. And so I've seen a lot of opinions. One thing we have a tremendous oversupply of now, when everyone has a voice, is opinions. So I generally say I'm not interested in hearing another opinion. Show me the data. But things like the proportion of renters, it's another metric, comes from the Australian Bureau of Statistics census data. So how many renters are in a suburb versus owner-occupiers? And there is a correlation to capital growth there. But some people have put forward that if the proportion of renters is too low, it might reflect a lack of interest from renters to rent a property there. But historical data shows that's not the case. There is a continuous correlation, so that the lower the proportion of renters, the better. And it doesn't even make sense from a logical perspective. What you're saying is that there are people who've committed to buy in this location. They've got a mortgage. They're after safe place, parks, schools, shops, whatever it is people choose. But for some reason, tenants don't like the same thing, as if they're different kind of human being. They want the same thing. It's more than likely, if you find a very low proportion of renters, it's because there aren't enough rental properties. And
the other thing around it is, like, typically owner occupiers drive the market, so they're the people who are going to be probably paying emotional prices, where an investor is going to look at it, and that's probably why there's not that many investors or renters there, because investors are saying, well, it's too expensive, or it's not value, or the yield isn't high enough. So then it goes back to why somebody. Here you go.
Yeah, some recent research that Luke and I have discovered is that the typical investment property historically in Australia has actually underperformed the typical owner-occupied property. So you think of these owner-occupiers that are making pure lifestyle decisions. They want to be close to family and friends. And the investors are making purely financial decisions, and they've actually made worse decisions than owner-occupiers.
Yeah.
It's fascinating metric.
That's why I hear all the time is people like, don't think with your head, not with your heart. And I'm like, yeah, do that. Think with your head. But also, if you're an owner occupier and you want to live there, like, there is potential that it's going to be a good area because it has all the lifestyle, has all the amenity, and that's got to be factored in. Is there a threshold of where it doesn't start to make sense to invest from a renter proportion? So let's say you see an area with 50% renter proportion. Are you like, yep, cool, we're not touching it. Not interested whatsoever. There's not enough owner occupiers to drive that market.
Yeah, it's I've seen a lot of this in how people use my website, the market matcher. There, you can put in those sort of thresholds, and the threshold approach is actually an inferior method. So what I'm talking about here is got to have a vacancy rate less than 2%, must have days on market less than 40, it's got to have, like you said, proportion of renters less than 50. What that will do is eliminate an enormous number of really hot suburbs. So I have never seen a suburb that has every metric better than the benchmark. So better than average. There's always 1, 2, 3 metrics that are ugly, but the rest of them could be blinders. So if you rule out, so say for example, there's a suburb with 200 houses, so it's a pretty small suburb, and you've got 40 of those are rental properties. Now, if one of those rental properties is listed for rent, it's vacant, then 1 out of 40 is 2.5%. Now, the vacancy rate for a balanced market we call is 2%. So if you set a threshold of 2%, I want better than 2%, then you've eliminated that suburb because of one metric, one property that got listed for rent for the month that you were looking at it, and you've missed out. And so you're undoing the work of the algorithm. The algorithm looks at these sorts of circumstances. It doesn't place a threshold. It gives every metric a score effectively, and then it munges that all together into a single overall prediction for capital growth. So the threshold approach is sometimes called a checklist. So it's got to pass this check and that check. Yeah, it doesn't really work out because you eliminate too many good suburbs.
So how would you do it then when looking for a good investment property? Because otherwise, if you have it real broad, you're going to have 80 suburbs, and you're like, well, 80's a lot. You cut it down even further.
The way in which it works, and this was the original idea behind the demand to supply ratio from 2010, the first version, it was combine all these metrics into a single score out of 100 for the investment potential of that property market. There are other ways you can do it. You can say, look, I'm after a 3-year growth period. So what is the prediction for capital growth over 3 years, or for 4 years, or 10, or whatever your interest is? And that becomes your target variable. You give the machine all the data, and it comes up with an algorithm. So, yeah, we're in an age where you just can't look at all these variables. Well, I mean, you can, but you'll be much better off by looking at an algorithm. And we're talking like tens, hundreds of thousands of dollars better off. I mean, yeah, the sort of accuracy we're talking about now is pretty phenomenal. I mean, when I first launched the demand to supply ratio back in 2010, there was very little data science that went into that. There's a lot of guesswork that went into that, more guesswork than science. And that has been outperforming a lot of the industry experts' best guesses. And this is just with 8 variables. And now we're talking about thousands and using the latest in data science. So, we're at a point where humans simply cannot compete with the machines for this sort of thing.
One of the questions I've got, well,
you feel
just numbers,
Yeah.
That was going to be my question. Is okay. Everyone now has access to the machines, the data, and the machine says go by there, and
is
then everyone goes. I've seen markets move. Like there are people that send, like there are large scale buyers agencies. There are course creators that get into a small market that has a small thing, and they're like, this area is going to boom. They send all their people there, and the place booms. It does really well because there's a lot of people and there's only 20 properties available. That drives up the price. What happens when everyone's got access to all the same data?
Yeah, well, it's an interesting phenomenon. I'd like to roll forward in time and see what happens, but there are some defenses against it. First of all, data science is still relatively new in this industry, so it's not like everyone's got an algorithm, and there are some shockers out there. I've seen one where really they are just they're offering the data for free to get your email address, and then they promote a developer's project to you, and there's very little concern about the accuracy of the data. And there's a lot of marketing hype out there. One of the things I have learned somewhat recently. I'm a slow learner. I think that the first thing that novice investors need to learn has nothing to do with property investing. They need to learn marketing. They need to know all the tricks so they can protect themselves from the marketing monsters out there that are salivating about a new sucker about to enter the market. They can take their money. There is a lot of nonsense out there. And it is very difficult to tell when you're a novice investor who's legit. And most of them turn to try and assess a character. This guy seems like he's on the level. Seems like just an ordinary chap. He's not going to deceive me. I've been spooked myself. I've been an absolute noob, trusted in a spruiker, and bought in an area which was abominable, and it's cost me terribly. And I can smile and laugh about it now, but when you're close to deciding on declaring bankruptcy or do I just tough this one out? There were many sleepless nights, and I paid, I think, $250 for a property report on some hotspots, and they were the complete opposite end of the spectrum. And that guy I bought from is still in the industry now, still selling loads of them, and is revered in the industry as an expert. But if you look at his historical past performance, in my mind, personally, straight up and down fraud. Anyway, dark side of tonight's session. Okay, so what if everyone gets hold of these algorithms? So this market cycle timing metric in particular, if it sees an enormous amount of growth in the recent past, then it will actually downscore a suburb. So there's some sort of self-feedback loop there. And these people who are promoting an individual area, they have to keep on it, keep promoting, keep pumping it up for it to have that sort of growth over 2-3 years. If they're only bashing it for 6 months, and if it's an empty market, it will only have growth over those 6 months. But you bring up a valid point that with the right kind of marketing, you can push a suburbs property market forward.
Yeah. And I guess how do you avoid it? You can't. There's no way around it.
But I think a lot of people have. Sorry, go on.
I'm interested to see, is there a way you can actually decipher between the two, or is it the answer is the algorithm is that sort of, or is there a way the average person that can decipher that sort of thing? Like, what sort of questions should they be considering when looking at any sort of data?
So that exact topic, like, is this just driven by investors? You can ask the local agents who you're typically selling to. So if there's a lot of owner occupiers, you're in the clear. If it's just all investors, get all these interstate investors. And one thing we monitor for is the property that's sold, is it then rented the next month? Because that means it's been bought by an investor. So you can monitor how many investors are active in a market pretty quickly over a few months. You can quickly realize, this isn't a market we want to attack. That's coming out in the new algorithm.
It's a really good way of thinking about it. Like, you can actually sort of pin it together, because let's just say you think you've discovered the next kind of capital growth darling. How much time before it's sort of too late to get into that market? Can you wait 3 to 6 to 9 months and before you buy into that, and sort of actually dip your toe in that data and say, well, yeah, it looks pretty good to me. Now I've confirmed it looks good. Or at that stage, are you sort of going to miss the boat?
I think that if the growth is going to play out over, say, 3 or 4 years, then 6 months is not so bad. Perhaps 9 is kind of, well, for every extra month, you're just missing out on a little bit more. But I'm slow to move on a market until I've seen something is definitely happening. So I'd like to see a high demand to supply ratio, and then just see prices starting to tick up before having more confidence. And quite often you can have a market within 2 months, all of a sudden the demand and supply ratio has gone from pretty ordinary, like 55, up to say nearly 70. So that I'd show some concern there. I'd prefer to see it gradually move up. That's more of a positive sign for me.
Yeah. So with one of the biggest, well, maybe not myth, but something I hear out there in the world is that buying in the CBD, buy as close to CBD as you can possibly afford. You know, you've got $500,000. Great. Okay, I'm now 30 kilometers away from the CBD. I just want to get as close to that little sucker as possible. Is that the right way to think about property investing? Am I wrong here? How does this stuff work?
Yeah, that's one I've heard many times before and argued vehemently by the old school, but there's no data to support that. Well, I shouldn't say no data, because there have actually what's aided this myth in having such longevity is that there have been some reports put out by reputable organisations like Australian Housing Urban Research Institute, the SGS Economics and Planning. You may have heard of this one, the RBA and Real Estate Institute of Australia. They put together a report which it looks like it suggests that there's going to be this great divide of people that own property closer to the CBD and those on the outskirts. But all of these past reports have been flawed in one or more areas. Some of them will just refer to, instead of proximity to CBD, like measuring it on a per kilometre basis, they just have inner ring and outer ring. That's just far too blunt. I've seen one, dare I call it analyst? No. Fake expert. I'm calling fake expert. They did some very back of the envelope analysis of Melbourne. They looked at 4 suburbs, each further distance away from the CBD, which is good. That's 4 rings. That's a plus. But the city has 400 suburbs, and they only looked at 4. So can we say that this 1% is representative of the rest? And another big mistake that I see made all the time is they only look at one time period. So when growth, a next boom starts, it usually starts in these affluent areas and then ripples outwards. So if you set the end of your period of analysis halfway through one of those booms, it'll look like properties closer to the CBD having better capital growth. But just play it forward another few years and it's back to even Steven again. So you need to look at multiple periods, multiple CBDs, using multiple data sources and different distances from the CBD. And that sort of analysis took me a couple of months to do, and I just couldn't find anything in it. So yeah, the demand to supply ratio, that algorithm does not include proximity to CBD because I just couldn't get it to work in any way. So there's no historical support in the data to suggest that you need to buy close to CBD. And there's a couple of other problems with it too. Property closer to CBD is more expensive. So there's more risk. You're putting more eggs in one basket. And there's a great report that CoreLogic put out. I haven't seen it for years now, called the Decile Report. And they showed the history from 1990, I think it was up until about 2018 when I last saw this report. And it shows the performance, the growth rate of the lowest 10% of the property market. So the price, really cheap suburbs. And then they compared it to the highest 10% and then compared it to the median. And over these, it was nearly 30 years back then of data, there were 4 recessions, 4 times where the Australian property market went backwards, had negative growth. And in one of those occasions, the cheapest end of the market didn't go backwards. And you can see in the chart, it has less volatility. The most volatile part of the market, and by volatile I means going up and down. You're looking at a chart, it has wild swings up and down. The most volatile end of the market is the upper end. And volatility is a measure of risk. So you've got higher risk going close to CBD, you've got more eggs in one basket, you have lower yields, and it doesn't give you any better capital growth. So investors wondering whether they should stretch their budget, just chillax. You don't need to buy close to the CBD.
Well, it's one of the biggest things that I see people oh, great, I just went to the bank. I have $1 million borrowing capacity. I can't believe it. I'm going to go out there and buy $1 million property. But it doesn't need to work like that, because you buy that $1 million property and then you're stuck. You can't borrow. The negative cash flow is hitting you too hard, and the bank will say, sorry, you can't borrow any more money. You're tapped out. But if you buy a $500,000 property here, with a 5% yield or a 6% yield, that's going to give you more cash than it would at a 2% yield. And then all of a sudden you go back to the bank and they're like, actually, you can borrow $600,000 more. So you then put that 600,000 in a 5-6% market, and that allows you to continue to go and borrow more.
And you can diversify as well.
And
two different sides of the country. Yeah.
Not that Joe's giving advice there at all. He's not telling you should go and do that. You make your own calls, people.
You do you.
It's illustrative, purely illustrative. Do you want to bring out these slides, Joe? I want to see these suburbs.
Yeah.
Let's
talk about
show us a slide.
Waverton versus Silverdale.
Yeah, this is an example.
Sydney.
Now, example doesn't. Yeah, so both of these suburbs are in Sydney. You can see that Silverdale, in the turquoise-coloured light green, has had more growth over the last 33 years than Waverton. Now, Silverdale is about 55 kilometres from the CBD. Waverton is 3.5 kilometres from the CBD. And although it looks like, it's better to be further away, what's important about this chart is not the endpoints, because it looks like Silverdale has had twice the capital growth as Waverton. What's important is that they cross over. There's points where the two curves diverge and then they converge. And that happens, it's repeated again and again over history. That's where one market gets ahead of the other. It then is considered unaffordable. The alternative seems cheaper. It catches up, and that cycle repeats itself. So that's just one sample of suburbs, but that doesn't create a general rule. So if you can go to the next chart. So this is Sydney's 10% of property markets that are closest to the CBD versus those that are furthest away. So Waverton will appear in this list. It's about 70 suburbs in each of these two curves. And Silverdale will appear in the light green curve. And you can see that, again, the curves diverge but then converge. And after 33 years, there's practically no difference.
What happened in 2009 to that just dropped off a cliff?
Yeah, so there's a little bit of an anomaly there with how we're measuring capital growth for these 10% that are furthest away. So don't worry about that. Just cast your eye across that.
But why is
Ignore
the
that
gap
dip.
so huge here? Like, that is a massive gap.
Yeah, and then it closes massively as well. So that could just be an anomaly in the data. But at the end of the day, what you're seeing is divergence, convergence, get ahead, get caught up, and that pattern repeating itself. And you'll see it. Yeah.
Sorry, how much should we be worried about when we see capital growth? So, there's a lot of suburbs over the past 2 years that have boomed. And like what you said, there's people that have thresholds for, okay, it's been a year, it's had 20%, 30% growth, cut that out. We're not thinking about that one anymore. Like, what is the point where you get a little bit worried for previous capital growth?
Yeah, I still do get worried, but I've learned to trust the algorithm. So if the algorithm has picked out a market that's set for high growth, so it's got a high demand relative to supply, but it looks like it's had some high capital growth in the past, then I still believe that there's more growth to come, because there is no single figure. You can't say, well, 30% in 18 months is too much. That's far too blunt an approach. And I've seen examples where people have ruled out a suburb because over the last 3 years, it's had something like 50% capital growth in the last 3 years. Now, that would have me worried. And if it was just my own human interpretation, I would probably scratch that suburb. But the same suburb in the next 18 months had 40% capital growth. So we don't know when these booms are going to finish, when the real peak of the market is there. All we can do is read supply and demand, and if demand is still crunching supply, then there's more growth to come, despite how much it's already had.
And how important is looking at the supply of properties that is coming to the market? Because that's what we're measuring, isn't it? What is supply? What are we looking at when we talk supply and demand?
Yeah,
what are we actually looking at?
There's two ways in which you can look at supply. There's the current supply right now, which is how many properties are listed for sale. Pretty simple metric. We calculate it as a percentage, because if you have a really large suburb like Reservoir in Melbourne, loads of houses, if 20 properties were for sale, that could seem like a lot for a small suburb in Adelaide, where you might only have, say, 200 houses. So we calculate it as a percentage to cover all those variations. And around about 1% of the property market is for sale most of the time. Some of these tight markets, it's obviously a lot less than that. The other way in which you measure supply is pending supply, supply that's on its way. So things like development applications, where there's a greenfield estate, all the trees are knocked down, and there's going to be 200 more houses built here. So my approach there, they can be very difficult to read, those development applications. So my approach is just buy in a built-up area where there is not a large amount of vacant land, and then you don't have to worry about that, because you can't build a whole bunch of houses. Now, you can build units, but that's a different genre, different property type. So you're somewhat quarantined simply by buying in a built-up area. But yeah,
so
that's
if you
supply.
look, there's some suburbs that are quite nice and established, and then on the outskirts of them, there's just all this greenfield estates. Like, how far away from the greenfield estates do you want to be before you're like, oh yeah, this is getting too close?
Yeah, I don't think there's any precise figure that you can give, like X number of kilometres or something. But and it really just comes down to the size of that greenfield estate. If it's like only 50 houses and you're 2 suburbs away, it's unlikely to affect you. But if it's massive and it's got decades of development in the future, then even if you are a couple of suburbs away, it still could thwart growth. But you don't have to go the opposite end of the spectrum and buy close to the CBD, as we've seen.
Yeah,
I've just looked up an interesting suburb, Joe. I don't know if we should talk about it, but why not? Let's bring it up. And you probably know Saul, Jeremy. Baldivis, mate. Baldivis has absolutely gone on a tear. Like, but how does that? Is that because I would have thought there's a whole bunch of land there, but like, it's just absolutely rocketed. Like, you're talking. I don't know if have you looked at Baldivis in the Rockingham area, Jeremy?
I am aware of the Rockingham area, and there are plenty of good suburbs there. There's been loads of capital growth already, and still more to come, I think. It has popped up on the radar a few times. So yeah, I'm not surprised that it's got such high capital growth. But your point about the vacant land that's around these areas, as a general rule, you would prefer to avoid that sort of vacant land. But if there is still strong enough demand despite that supply, so there's two sides to the equation. You want high demand and low supply, ideally. But if you have really high demand and just moderate supply, then you'll still get excellent price growth. So my business partner has bought in a greenfield estate. It's something we tell people, avoid this. And he's gone and done it, and he's made money because he knows what he's doing. So if you're a novice investor, it's one of those things that you probably want to avoid as a general rule. You put enough general rules together and you're less likely to make a mistake. But there are people who know what they're doing, who can break the rules from time to time, because there are always exceptions. You will find high growth in greenfield estates sometimes.
Yeah, great. What myths do we need to tackle next? Is it about infrastructure? Oh, no, infrastructure, but it's about shopping centres,
schools, shops, transport. Right. I need to be near a train station because that's just how I need to do. I need, I want to be near a train station, so that means my investment needs to be near a train station. What is this?
So I think it was almost 5 years ago now. I did analysis on amenities, things like schools, shops, train stations airports, beaches. I think there were 5 of them. So this chart is showing Sydney suburbs that have train stations. This is the growth they've had over the last, I think this was only 28 years. So since 1990 up till about 2020. So it was a few years ago that I did this analysis. And you can see that there's very little difference there between the growth in suburbs that have a station and those that don't. So over that period of time, there's nothing in it, and there's a few touch points there. The next slide will show another amenity. Can't remember which one it is. Okay, so this is in Melbourne. Yeah, classic schools. So Melbourne's well known for some of the suburbs have these classic schools. They've got a long history, and people will pay a premium price for property in that school catchment zone. But as you can see from these two curves, the suburbs of Melbourne without these classic schools have performed just as well as the ones with. So no real driver of capital growth. And the reason for that is if the suburb has one of these supposedly desirable amenities like a good school or a train station, it's probably had it for a long time already. And so it's factored into the price of properties. So you're not going to see continued above average capital growth. Like that analogy I gave with apples and oranges. If it's still an apple after 100 years and still an orange after 100 years, why has one gone to $44 whilst the other is only 50 cents? It doesn't make any sense. And we see this in the data. It doesn't make any sense. It's if there's a new amenity that turns up, then there'll be a period of, well, if it's an attractive amenity, then there'll be a period of accelerated growth. Queensland University of Technology did an interesting study of historical data of Brisbane Airport. I think it was back in the 80s, the airport had a change to the flight path. It might have been when they were going international, I'm not sure. But there were some suburbs that were affected because they were under that flight path. And Queensland University's technology, their analysis of the historical data showed that those suburbs had inferior growth for around about 4 years after the flight path was changed. And from then on, it was just business as usual. So eventually, buyers factor in the noise, prices are reduced, but from then on, it's just business as usual. And if you look at the next chart, so this one was schools, the previous one was train stations. Beach. Right, yeah, so Sydney has some suburbs with premium property, beachside, genuine beachside, and you can see here these two curves, they don't really show over time any dramatic change in the growth profile, whether you're in a beachside suburb or not. So the beach has been there for a long time. It's already factored into the price of property. I think I got one more, do I?
Those little sort of blips. So it's great. Just wondering what it's got to be like a smaller. I'm just trying to figure out why that would be such a.
Well, bear in mind that the number of Sydney suburbs that have a beach is actually quite small. So that purple curve, which is the beachside suburbs, it's got some jumpiness in it because there's just some a lack of data, small sample size. So the green curve is a lot smoother than the purple curve.
Yeah.
Okay.
This one's big shopping centers versus those that aren't. What are the things that really make a difference then in terms of capital growth for maybe this is more of an infrastructure question than but what actually makes a difference and converts it? Because if you've got like one of the things is, the Bruce Highway, right? They're upgrading the Bruce Highway. They're spending $5 billion. Oh my gosh, that's amazing. And then the road goes around this suburb. That's obviously going to have a negative impact rather than a positive impact. What do you see as being the high value things to look out for when we are, looking at infrastructure and things coming in?
Yeah, historically, infrastructure has not been the big leader or predictor of capital growth. And so the algorithm hasn't really capitalized on that. We've been working on this algorithm, version 3, all this year, and we've
we had Luke on. He was telling us all about it.
Oh yeah. Oh, excellent.
Well, he was hiding a lot of the good stuff. So we'll have to get you guys back on together to decipher the goods.
Yeah, sure, I'd love to. But there's issues with infrastructure in that the timing is a problem. Like there can be an announcement. Does that affect growth? There can be delays. Most buyers, they want to see something there. They want to use it. They want to jump on the train. They won't buy speculatively. It's usually investors that will do that. And there's a lot of things that influence the decision of a buyer, not just having a train station or a school. It could be just simply being close to family and friends. We don't know where your family and friends are, so how can we score that? Or it could be access to leisure centres or places of worship, or there's an enormous number of things. So when you talk about a single infrastructure project, it's usually quite a small thing. It might be just 1 out of 20 ticks that a buyer will consider. And the bigger the infrastructure project is, the more you think that demand is going to increase. But all of those big infrastructure projects are well known by property developers, and they capitalize on that. They use it in their marketing. So there's a great example, and I got burnt by this. I bought in Gladstone in 2008 because there were $90 billion worth of projects earmarked for Gladstone. With a population of only 30,000 people, that's $3 million of infrastructure project for every man, woman, and child in that city. So surely that's going to boom. Every developer and their cuz knew about it and just built so much. There was such an astronomical oversupply. Prices went backwards. There was massive vacancy rate. I can remember renting out a property for $150 a week just to get someone in there, just so there's someone there. And I'd have to wait for a long time. That investment was off a hotspot report that I paid a few $100 for. That I've calculated the opportunity cost of close to $1 million from that mistake. Wow. Good example of getting things right. And I was a bit of a noob still then. Infrastructure projects historically have not been good predictors of capital growth, so we generally just don't include them. The bigger they are, the more developers know about them, the more supply you're going to get. And Badgerys Creek in Sydney is another good example. It could result in tremendous capital growth for those areas, but there's an enormous amount of vacant land there. I don't know if developers are going to go nuts or not, so I don't want to risk it.
Well, because the other thing I was going to say, like that's been known for, I think they announced that 6 or 7 years ago.
20 years. No, it's been around like 20 years.
It was clean though. They were sort of fighting it, and I think they eventually said, yeah, it's going to happen in about 2017, maybe 2018. I don't know exactly when it was, 2016, sometime. But they were sort of talking about it. They were fighting. They were saying, and then they sort of said, yep, it's going to happen. I think they broke around about 2019, 2020. Correct me if I'm wrong. It could have been building it for a while.
It's boomed.
But
the whole area has gone from
and then they sort of built up the Oran Park, the Harrington Park, all those sort of and places. And I just think, well, what is actually, are people buying there just because of that airport? Like why? But people have made probably a good amount of money there. So
I think it's largely driven by affordability. They're just so desperate for housing in Sydney, and Sydney's so
expensive. It's not so expensive out that way. Or wasn't expensive?
It wasn't.
So what do we got here? So what we got another expert bust. Big shopping centres versus those.
Shopping centres. Yeah, so I looked at some of the larger shopping centres. This is countrywide, not restricted to an individual city. And although you see at the end there does look like there's a gap, you can see that the history has shown a lot of crossover points. So it's just a case of roll that forward another 5 years, and it might show another convergence, another touch point of those two curves. So there's nothing consistently in this to suggest long-term outperformance. And you're asking, Joe, what can we look at? And you suggested infrastructure. One of the problems with finding long-term outperformance is you've got to look back at data from a long time ago. So if long-term is 20 years, then you need data from at least 30 years ago. And the data age is a little too new. So we don't have a lot of historical data that we can look at. What we've got now is an enormous amount of data compared to just a decade ago. But going back 20 years, it's really threadbare. So there's really only a few things that I've found that are definite. If your plan is just buy, hold, wait, you've got time on your side, then it's really easy. You don't need all this data. All you do is buy a house. Houses have outperformed units in a built-up area, so not near vacant land that can be oversupplied, and don't buy a new house because of the higher rates of depreciation. So those are three things that historical data has shown work over the long term. So if you were a long-term investor, it's pretty simple. So you don't need any of my data if that's your plan, just to hold long term, which makes it easy too.
That's simple. There you go. Any other golden
rules?
I
like to outperform though. I like to outperform in the shorter to medium term because I don't know, but my boss is not. I mean, boss is not that fun to. I mean, I'm my own boss almost essentially. But,
and like I said, there's this tendency for all property markets to grow at the same rate over the long term. So you are going to be closer to the average if your plan is to buy long term. But the good news is that if you're a novice and you just couldn't be bothered, then it is easy if time is on your side. Of course, if you're nearing retirement, you're in your late 40s or 50s, then you might not have the luxury of waiting 25 years for things to come good. And I'm of the belief that this gets a bit controversial. I actually trade property, so I'm okay with buying and then selling. I like to ride the wave of growth. I know that it's at its peak and I can sell. So in the past, that sort of advice has been would have been, well, no one would have given that advice because no one could accurately predict capital growth. So it's a case of you buy somewhere and just sit tight and wait. And although that was good advice in the past, and it's not bad advice now, it's just not the best advice. So you can actually trade property. And I think we'll see that more and more as AI has a bigger influence in this industry. There will be a lot more trading of property. Property investors will be in and out of the market.
I think to your point, sorry, I was going to say to your point there, like when somebody's sitting, or another sort of thing why people may be considering sort of selling instead of just holding and passing on to the next generation is people may have sort of millions, like several millions of dollars worth of equity, but they can't extract it. So they may not necessarily have any other, not a choice, but I suppose the choice is if you can't sort of go and borrow it and use that to live off, then, well, how do you sort of see your equity rich but cash flow poor? So we were chatting to Jeremy about that yesterday. Well, different Jeremy. We've got him on a couple of weeks. Accountant Jeremy.
Yeah. So it's that's one good thing about this. You just sell one property and that equity goes into the alternative, the better one, and eventually you get to a point where you're independent of the banks. You can just pay for the next property in cash, and you don't need a huge portfolio.
Yeah. What are some of the things that lead to you selling? What are your selling green flags? Okay, cool. I bought this thing. I held it for 18 months. I held it for 3 years. Green flags coming up. Time to ship out.
Yeah, there's two things, broadly speaking. So first of all, there's going to be a cost in exiting. You've got to pay an agent to sell your property. You've got to give them a commission. That's a hefty sum. The biggest one, though, is capital gains tax, especially if you've held the property for a long time. So you need to estimate capital gains tax. And then there's buying the replacement property. You've got to pay stamp duty. So we call those recycling costs because you're recycling your equity. You're taking it out of this property, selling it, and then buying an alternative property, perhaps on the other side of the country. If the recycling costs are larger than the opportunity cost. The opportunity cost is what you're missing out on by continuing to hold that property, which might be a dud. If recycling costs are larger than opportunity costs and by a good whack, then you're better off just holding. But if opportunity costs exceed recycling costs and by a significant margin, then you're better off selling and buying elsewhere. So it all comes down to the prediction of capital growth for the property that you currently got and the one you intend to replace it with. And if there's a big difference there over, say, the next 3 or 4 years, then it might be enough to override the recycling costs and you could be in a better position. But it's a case-by-case basis. Like I've got a property that I've held, that first property, that nightmare property, I've held that for over 20 years. Every time I do this, should I sell analysis, it tells me no, because you're going to pay too much in capital gains tax. But I still check
now close to $1 million, I'd say, depending on which pocket of Penrith it's in.
Yeah, I haven't had it valued for a long time, so yeah, I don't know.
Yeah, I reckon it could be.
Yeah, but from
I like it.
200,000 to $1 million, that's 800,000. You get a 50% CGT
Too
discount,
much
so that's
tax.
400,000. So I'd be paying $200,000 in CGT roughly.
Oh, that does look
Yeah.
a bit painful, isn't it?
But that's only 20% capital growth on $1 million property. So if there's a 20% difference in capital growth between this
Or two
property and the
$500,000
alternative,
properties,
or two, brilliant, yeah, very good.
Should we
I
throw to
I
a
want,
second ad?
yeah, I want to jump to some questions as well. Anyone that has any questions, throw them in the comments, and we will hit them up as well. And I think we've got a couple more questions to go through ourselves. So let's dive in.
There's nothing worse than going into a situation unprepared, especially when that situation is purchasing one of the most expensive assets of your life against a trained property expert in the form of a real estate agent. It's a scary thought, but it is a skill that can be taught. Do you want to learn how to become fully prepared when buying a property so you can get out there, buy your dream home or investment property without the fear of actually messing it up? Scott Agate, the founder and expert property negotiator at Hello House, has been helping people buy their properties by stepping in and negotiating with the agents and saving his clients tens of thousands and in some cases hundreds of thousands of dollars. Scott has now decided to share all that he's learned over the past 28 years in real estate so you can go out there and do the exact same thing on how to find a property, analyze that property, negotiate on that property, and transact on it to get the best results. He's created the Get Buyer Ready course, which is a step-by-step guide on how you too can become an expert property negotiator. It's the easy way of how you can avoid all of these agent games and get the best purchase price on that dream home or your investment property. The course is in short bites for busy people with no fluff at all. Just all the information you need to get buyer ready and secure that next property with confidence at the best price. Scott has been kind enough to give our community a massive discount with the link below. Sign up today before you even think about putting an offer on that next property, and it will be one of the best decisions you ever make.
I did.
Yeah,
There we go.
Kept on going. So should we throw to some examples or some areas that people or not areas that people that Jeremy has nominated as some examples? Should we do that?
Yeah.
That's in a slideshow.
Oh.
I could read out the suburbs, but
last slide.
Yeah,
Okay.
Sorry. Should be more specific.
Oh God, what's happening? Oh, what? We want to go to the goods.
Yeah.
Where are
we go. We missed. There's another high wages, or I think let's talk about this one. This is an interesting one. This could be a bit spicy.
Yeah. Wait.
All right, I'll try and rip through this really quickly. So another thing claimed by fake experts is that you should be buying in areas where there's high income earners, or where there has been high income growth. And this chart shows that there's nothing in it. So the black bar on the far left, that is the highest income earning suburbs in Australia, and the red bar on the right is the lowest income earning suburbs. And the height of the bar represents capital growth over that 28-year period since the 1991 census. So I did this a while ago. It's only 28 years. So you can see there's nothing in it. And if you go to the next chart, the one the other way. Yes, that was the chart before. Yeah, that one. So this one is change in wages over a 5-year period, examining the capital growth over the following 5 years. So is change in wages a lead indicator of capital growth? And although there is a bit of a slope to the line of best fit there, there's no clear. It's not really significant enough for wages or wage growth to be included in the algorithm. So yeah, we don't look at this. This is household income that comes from census once every 5 years. So there's no real driver.
If it's going up, if it's gone from $1,500 a week to $1,800 a week, that doesn't make a difference to capital growth.
That's right. Yeah. So there's a number of different theories as to how to use it. One is just high wage areas. Another is the wage of a suburb versus the state average, or change in wages. And I've looked at all of those three cases and couldn't really find anything useful there. And this chart
What's this?
here,
Yeah.
this compares Mount Druitt, a suburb of Western Sydney, versus Mossman, an exclusive suburb of Sydney. So these two suburbs are polar opposite ends of the income spectrum. The average income in Mossman is literally double that in Mount Druitt, and has been that way for the last 3 decades. And yet you can see here that the capital growth is not that different, except for the last year where Mossman really took off. But what's more important is the fact that they have diverged and converged. That same sort of pattern that we've seen so many times before, where a suburb gets ahead and comes back down to reality. The bridesmaid has the opportunity to catch up, possibly even overtaking. And so,
I'm just looking at what happened in Mossman. I suspect people, maybe some really sort of rich sort of expats or something, or they really were buying up Mossman because the sales close to doubled in Mossman over that, or maybe not doubled, but they at least sort of 150 times over that sort of period, and it went from 3.5 to over $5 million. So you've almost made 200,000, 2 million. Crazy.
Yeah, beats having a job, doesn't it? Yeah.
Just trade.
What are we looking at here? What's this?
All right. So yeah, there's a lot of theories to why you should be buying in these high income areas, and why is it that the data shows that there's nothing in it. And this is my possible explanation. Obviously, I'm just speculating here. So this is to help come up with a reason why it might be possible that the data is not telling us furphies. So how does a person with a salary who's got a wage rise, how does that flow through into their property and lift the price of properties in that area? So first of all, out of all the residents, some of them are tenants, and tenants are not going to spend their surplus cash on the property that they're renting. So straight away, you're down by 30%. Out of the remaining 70%, which are owner-occupiers, roughly, there's an enormous number of things they can spend their money on, this surplus cash. They don't have to spend it on the property. They could go on holiday. They could buy a new car, or a boat, or a caravan. They could buy furniture, jewelry, clothes. They could buy some shares. Or they could buy an investment property, or they could just simply pay down the mortgage. They don't have to pump all the money into the property. And if they do, that's a capital injection. It doesn't increase the price of the property until that property is sold, and that's unlikely if you've just spent all this money getting the property just the way you like it. So there's a lot of ducks that need to be lined up here in order for a wage increase to flow through into the increase of a property. And if that property's value is increased, it doesn't increase the one of the neighbours. Your renovations don't increase the value of your neighbour's property. So this is my speculative argument as to why we're not seeing anything in the data that supports wage growth.
So why is Bondi more expensive than, maybe not a mining town, but more expensive than Perth?
Yeah, well, it's always been more expensive. It didn't have the higher capital growth. So all property markets did not start at £1 200 years ago. You think if we were to start a new suburb, wipe out the Royal Botanical Gardens in Sydney, just beside the Opera House, and put in a new greenfield estate there, will houses typically sell for 700,000 or 7 million?
7 million.
Yeah. So but then you go to the far northwest of Sydney, and you could be looking at 700,000. So property markets that are closer to the CBD in these exclusive areas have always been more expensive than the ones further away. So there is a correlation between higher prices and proximity to the CBD, but not higher capital growth. Certainly not over the long term.
So I was buying one that Bella Vista. I'm seeing some ridiculous prices there. Like I've seen some posts in the group. But anyway, I digress. Let's talk about what's this top spots we're looking at here. Like,
I knew that all my content was I'm talking about here's what not to look at, here's what doesn't work, here's some metrics, but they're no help to you. So I just thought I'd throw in some hotspots out of the website that I got this afternoon. So these are the top dozen according to the demand to supply ratio, which is the predictor of capital growth. So they're ordered there from highest to lowest by DSR.
How much
and
do you
all
know
of
about
these,
these suburbs, Jeremy?
Haven't looked at them, although I have seen Aurelia pop up a few times and Dun Craig. So they're in Perth. And Bundaberg. Bundaberg has popped up. There's a few. Was it Svensson Heights and a few other Bundaberg suburbs? Really cheap entry point there, around 400,000. High yields and good growth potential.
There's even a blue chip in there, Caulfield. Would you consider that? I mean, that's kind of inner Melbourne.
Yeah, Lane Cove North, that's pricey, 2.2 mil. I mean, high demand relative to supply, but that'll drain the bank account.
Yeah, Lane Cove North, 2.7% yield. Why not? Treat yourself. But if it's going to grow 5%, like that's 5% on $2 million is quite a little bit of change.
Yeah. You just have to have $1 million income though, Joe. Probably at least to be able to service the mortgage in there.
Yeah.
Yeah, that's more for the affluent types who are probably looking for a principal place of residence rather than a rental property. But knock yourself out if you're an investor with that kind of cash.
So what do I do with this? What do I do with this data now? Let's talk about Aurelia, right? I see Aurelia has one of the highest DSR scores. It's within my price range. It's got a vacancy rate. What would rule this suburb out for you now? Like, how would you say, you know what, actually, this is looking good from a data perspective, but actually I'm not going to buy here?
Right. Well, the first thing I would look at is the historical chart of the demand to supply ratio. Is 72 a one-off high, or has it been heading up that way? Has it seen this sort of rarefied atmosphere before? Because sometimes you can have, based on how real estate agents conduct their business, they can, to some extent, skew the data. For example, let's say a developer has released a block of units and they are advertising a 1-bedroom and a 2-bedroom unit. And let's say there's no 3-bedroom units in the complex. So we've got stock on market of 2 additional units, but they're just samples. There may be 100 units in the complex. So we're underquoting our stock on market. There could be lots of those little things which influence the data. So I check for volatility in the historical chart. That's the first thing that I look at. I want to see, does this make sense, or is it going to just come back down to 60 next month? And then I would check, if I didn't know Aurelia where it is, I would check the satellite imagery. Is this surrounded by a lot of vacant land which could become a greenfield estate filled out with oversupply in years to come? So I want to buy in a built-up area. And another thing I would probably do is look for surrounding suburbs. So although it's not on this website, but there is a heat map where I can check to see where there are clusters of heat. So are there any suburbs surrounding Aurelia that also have a high demand to supply ratio? That lends more weight to the argument this is a hot market.
Yeah, and it's less of a data statistical error because everywhere around it's doing the exact same thing.
Yeah, so there must be something going on here. Yeah.
And then what about
if anybody knows anything about that Rockingham and surrounds and Koana at the moment? Leader and what else is there? There's all those sort of
So what about areas that are pretty rough? Like Aurelia is pretty rough. How do you think about investing in areas that are a little bit less desirable? And at what point do you say, yeah, long term, I'm a little bit worried about this one?
Have a cry though, Joe?
Yeah. I'm not at all worried. It's almost like a red rag to a bull when I hear of lower socioeconomic demographics and high crime rates, because historically they just simply have not underperformed like you would have expected. That just hasn't happened. I mean, I live in Mount Druitt. I grew up in Mount Druitt, and that has a very low socioeconomic index compared to the rest of Sydney. And in Sydney's most recent boom for 2012, 2017, where Sydney prices went up by, I think, 80%, in Mount Druitt, that sort of 2770 postcode, went up by about 110%. So, and I've seen it before in Corio, as I mentioned before, and in the northeast of Adelaide over recent years, pretty rough areas. They will eventually have good capital growth. So there are a lot of it's a tough sell. Being a buyer's agent, you've got to try and convince your client, no, this is a good spot. It's a good spot. There's lots of criminals here, but there are a couple of things you can do to protect yourself. I mean, number one is landlord's insurance. Number two is you don't ask for too much rent. So if your property manager said, I think we can rent this property out for $400 a week, then I would say let's put an ad out there for $380. We get a large number of applicants, and I picked the one that has the biggest, longest, most reliable track record, and that protects me. Plus, there's the landlord's insurance, and of course, you want to vet your property managers well too to make sure that they're doing a good job. I had a property manager once in New Zealand. There's a town in New Zealand. I owned 6 houses there, and the property manager was friends with one of the tenants, and they eventually got fired. The property manager got fired, and the new property manager said, "Oh, Jeremy, I've got some bad news. The tenant has really let this place go to." There were holes punched in walls. It was just another nightmare story. So you vet your property manager well. Get landlord's insurance. Don't be too greedy with the rent.
Yeah. They're good tips. Solid tips. Let's jump to some of these questions that have popped up, because I am cautious of your time as well, Jeremy. I thank you for sharing so much.
It's a great one. Have you looked at comparison? And this is from Gurov, and I love that Gurov's jumping on. We're trying to get new guests for you as well. Anyway, have you looked at comparisons of high versus low crime suburbs and their performance over long term? You probably would have.
I actually haven't, but I have heard some. I've heard two people do some research on it. One concluded there's nothing in it, and the other person was Luke Metcalf of Microburbs, and he said it's almost a good sign to see high crime, depending obviously on other metrics.
You're not gonna sort of where you live. You're not gonna rob, right? Probably. So I mean,
that's right.
I don't think that's the answer.
Get Luke back on the show. He will have some amazing insights on that topic. But I haven't personally done the analysis on that. But I don't think it's anything to worry about. It's almost a good sign if crime rate is high, which sounds so counterintuitive, but fact is stranger than fiction.
Maybe throw in housing commission there as well. Like I suppose we're just throwing variables.
How do you think about housing commission?
I have done some analysis on housing commission, and again, it's like the analysis of amenities. If the state housing has been there for a long time already, it's already factored into the price of property. It's when there's a significant change, and sometimes it's when housing commission decide to sell up and move those people elsewhere, move those houses elsewhere.
It's an opportunity, maybe.
Yeah, it's an opportunity.
But how do you, is there a way? I mean, maybe we shouldn't talk about this on a live session because maybe let's talk about it because then everybody can democratizing the. Yeah. How do you is there a way of telling when Department of Housing is going to sell the property in advance? Like, how do they decide they're doing that? Do they gazette it or what's?
Yeah, I don't know.
Should Google that.
Yeah, because they should keep that a secret until there's like a public announcement, shouldn't they? There shouldn't be anyone who has the advantage to get in early and make an offer.
No, definitely can't have front running. Yeah. No, it should be.
Yeah, I don't know. I remember some public housing went off in the rocks a few years ago, and I thought, wow, can you imagine?
Sold for $2 million for each or something, and that's crazy.
Yeah. Salem Mahaja, eat your heart out. Remember that guy? Just
Auburn there, wasn't he? Or Granville.
Yeah. How is gentrification a strong indicator for capital growth?
Well, there's a lot of these sort of demographics that you get from the ABS, which will be loosely termed sort of gentrification. obviously there is something in gentrification. It does have some influence. People see a suburb become more appealing, and crowd draws another crowd. I'm not sure whether there are any metrics that I've looked at that I can remember doing some analysis on. Most of the demographic data that I've looked at from the ABS has been pointless. Just, you got to look at a lot of data before you find some gold.
What's like Luke's hip score, like how cafes are coming in?
In fact, I think Luke's probably in a better position to answer that question than me, so I'm going to pass. Sorry, don't know.
Pass that one. That's all right. How about a land versus house cost ratio? Does a correlation between higher land values exist?
Yeah, this is awesome, this one. So we call it land asset ratio. So let's imagine a $600,000 property, and it's in a greenfield estate. The developer has paid $200,000 to purchase the block of land, and then they spend $400,000 building the property. So you've got a $600,000 property with $200,000 worth of land. Now that is a land asset ratio of about 33%. So
that's really low.
200,000 it's really low. And just about every new property will have a very low land asset ratio. Now contrast that with a $600,000 property where it's the opposite. It's $400,000 block of land, and because the building is a bit old, it's only worth $200,000. Now a certain period of time passes. Let's assume that the land doubles in value. So the new property, the land goes from $200,000 to $400,000. Over the same period of time, the building depreciates, let's say to half. So it's gone from $400,000 to $200,000. So if let's say a 10-year period, you've still got a $600,000 property, same price as what you purchased before. Contrast that with the old property, which has a high land asset ratio of 67%. The land, which is $400,000, goes to $800,000. Even if the dwelling halved to $100,000, it's still $900,000. There's a $300,000 difference. Same capital growth rate, just new property versus old. So land asset ratio, really important. Once you've picked your suburb, make sure you check land asset ratio.
Is that why like house and land packages may generally underperform existing stock? Is that one of the reasons? Probably.
Yeah, and I have a theory that the reason why so many investors have been dissatisfied with their foray into property investing is because they go for these new properties and they get that sort of performance, and they just think, well, this did not go anything according to plan, I'm out. And they don't know what they did wrong, but it's things like that. Don't buy new. As a general rule, don't buy new.
Yeah, that's good tips. Good. Yeah, I like that one. I'm all for don't buy new. And if it was, if new made sense, I'd be talking about it. But have you done any studies or anything like I haven't seen like a real deep dive into new versus established dwellings, and I would love to do the research and kind of get the numbers and the data down onto it, but it's a lot of work, and I don't have the time to do that.
It is a lot of work. I got some data off the Queensland government, which was one of the few occasions where I was able to find the date, the age of properties, and do some decent assessment, but just didn't go back far enough. But it was enough to show that new properties definitely underperform compared to old. And on the land asset ratio, there's some data that I've got from New South Wales government looking at just land values, and I've tried to estimate land asset ratios. And Luke has done more work on this. So yeah, land asset ratio is definitely, when you're choosing the asset, it's a really important selection tip. And definitely, new property has underperformed. But yeah, right, Joe, there's very little historical analysis that's been done on that.
I don't know how you would do it. I
guess
we could dive size.
another 10 minutes.
Yeah, true. Better not. So there's a question here. What were your tips again for novices? So we're starting again. First-time investor. So one, don't buy new houses. What are the others? Small land sizes.
If you want to start with zero, it's learn about the marketing tricks of the monsters out there that are about to rob you. After that, the simple, the three things are old, not new, house, not unit, and away from vacant land. Avoid the greenfield estates.
Oh, the house versus unit is very controversial, but I think we're not controversial, but it's highly topical. But we will otherwise, if we start talking about that, we'll be here for another hour potentially, because I'm sure it's a very interesting one. But let's leave that for another time. I might have to get you
Actually,
back on.
here's let's do this as the last question. What does, and maybe you have no answer to it, but the government is committed to building 1.2 million dwellings. Is this possible? What are your thoughts on that?
Yeah, well, I mean, anything that addresses the supply shortage is probably a good idea. I do think that 1.2 million dwellings is over a significant period of time, and during that period of time, the population is also going to grow. So some could argue, well, it's not enough, but it's certainly better than nothing. And yeah, there's a lot of complaints amongst first home buyers of how difficult it is. It's certainly harder to get into the property market now than it was when I was buying my first property 20 years ago. But 20 years ago, there wasn't the data that we have now. So rent vesting is a relatively new concept. And that's something that every person in Sydney or Melbourne who's worried about, I cannot afford $1 million property. How am I going to get into the property market? Well, you don't need to buy in Sydney or Melbourne. Just keep renting where you need or want to live and buy in Perth. I mean, that list had some property markets under 400,000, Perth or Bundaberg. What is the chance that the best place to own a property right now just happens to be where you want to live? Highly unlikely you will ever live at any point in time in the best suburb for capital growth in the country. So from a financial perspective, you should always be renting. But as sooner or later, you're going to have to make that lifestyle decision. Oh, I don't want to be shafted by the landlord who wants their property back.
I want to paint the wall purple.
Yeah, yeah, that's right. So, but lifestyle aside, it just doesn't make sense to own where you live.
There you go.
Doesn't make sense to PPOR it up. There you go. Okay, so you've been hinting a little bit about this this thing with Luke. What's in the works? How can people learn more? Well, one, how can people learn more about you and what's coming up? How can we get excited about this thing?
Yeah, so dsrdata.com.au is the website we've currently got running. When it first launched in 2015, people told me it looked like it was built in the 80s before the internet was even made. So it's reached its end of life. We're building a replacement website, suburbdata.com.au. At the moment, there's just a coming soon page. And of course, the most important thing is the algorithm, the demand to supply ratio. And that's what I've been working with Luke on all this year. So early next year, we'll be launching a new website, and we'll have fireworks go off and let everyone know. But yeah, we're hoping that over time it will become a really useful research website for investors.
Yeah. Well, I mean, you've already got a list of suburbs that people can explore, and data is king. You got to trust in data. We trust. It only makes sense.
Data we trust. That's right. Data's the new gold, the new oil. We should be mining. Data mining. There we go.
They do mine it, yeah. A Bitcoin or something. No, that's not data. But yeah.
Anything?
Thanks, Jeremy. Love the insights as always. Sorry, go, Joe.
Yeah. No. I loved it. Good session. You thank you very much for taking so much time. People are loving it. So jump on the website, jump on the link and learn some more. Thank you very much, mate.
Yeah, I could have easily kept chatting for another. I could easily keep chatting for another 2 hours. So I really appreciate your dedication and just 2 hours would probably I might be asleep. I have to go and get myself a nice strong coffee. But no, right. Thanks for jumping in and joining us as well, Jeremy. And yeah, hopefully you all have a
thanks
great...
very much, guys. Leading up to this, the chats we've had, it's been really good, and I love chatting too. I love talking about data, and I hope it's been helpful for your listeners.
Yeah, people are loving it. Let's go buy a property. See you guys later. Have a good one.
In a good
Cool.